bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the July 28th, 2026 episode. My guest this week, as those of you who are watching on YouTube can see, is my partner, Tony Grappone. Tony is based in Novogradac's North Andover, Massachusetts office. Now, anyone who has watched or listened to Tax Credit Tuesday before should recognize Tony. He is the most frequent guest and guest host of the program. Today marks his 40th appearance on Tax Credit Tuesday. Congratulations, Tony.
Thanks, Mike. Great to be here.
You hit 40 appearances the same year that Local Building Tax Credit hit 40 years.
I love the coincidence. Yeah.
So Tony is back on the podcast today to review a 10-point mid-year check-in that he's developed for asset and fund managers that are working in the renewable energy tax credit space. Now, mid-year 2026 is particularly notable. It's a particularly notable year for a mid-year check-in. And that's because, of course, as of July 4th, that's the date that solar and wind developments needed to begin construction in order to be eligible, for the most part, for solar or wind energy tax credits. Before we dive into the 10-point checklist, though, Tony and I are going to review the current status and impact of the recent federal court ruling, recent as in early June. This is the federal court ruling that vacated IRS Notice 2025-42. And those in the renewable energy space know that was the notice that greatly restricted the 5% safe harbor for start of construction for solar and wind transactions. In that ruling, the court emphasized that the IRS did not adequately address the historical industry reliance on the 5% safe harbor or adequately respond to proposed alternatives that were raised during the rulemaking process. So we're going to talk about that first and the actual practical impact of that. And then we'll go into the 10-point mid-year check-in. This is a check-in that conceptually falls into three major categories with a fourth kind of catch-all. The three major categories each have three. We're going to talk about three generally accepted accounting principle topics. We're going to talk about three tax topics. And we're going to talk about three financial topics, two of which relate to cash distributions. Then the fourth area that rounds out the top 10 is to discuss the impact of the Alta wind case. That's something that many of you, when I mentioned we were going to be discussing a court case, you might have been thinking we were going to talk about the Alta wind case as opposed to the Oregon Environmental Council case that led to the vacating of the IRS Notice 2025-42. Now, this is the latest episode in our Renewable Energy Tax Credit Finance series. Tony and I started this series in 2023, which when I read that date, I was like, it's certainly more recent than that. To provide real-time, on-the-ground perspective about important issues and topics facing those working in the renewable energy tax credit area. We have a lot to cover today, so if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday. You've never heard that before, have you? Or maybe you've heard it 40 times before? On your 40th appearance? Given that, I know that many in our audience are familiar with you, but every week we have new listeners. So for those that are hearing from you the first time, please share some of the services you provide to Novogradac clients.
Sure. Hard to believe we've been doing this since 2023. I feel like we just started a year or two ago. So time flies when you're having fun, I suppose. All right. So great. So most listeners who tune into this podcast regularly know that I oversee three silos of services here at the firm. Silo one being what I like to refer to as transaction and advisory services. That's financial modeling, cost segregation studies, consulting services, et cetera. Silo two would be financial statement audit service and other types of attestation services. The third category would be tax return preparation types of services. This podcast, we will touch on topics that cut across all three of those silos of services. So great session today. We get to cover a lot of topics, great mid-year sort of check-in opportunities. And again, they cut across transaction advisory, audit, and tax.
Great. Thank you for that, Tony. And as I mentioned in the introduction, before we dive into the discussion of this 10-point mid-year reminders for asset and fund managers, I did want to get your thoughts on this recent federal court ruling that invalidated the IRS notice. And this is the notice that greatly limited the use of the 5% standard for start of construction, the safe harbor. Now, as best I know, the current status of this decision is, first of all, and of most note, the district court entered final judgment on June 6, 2026 that vacated IRS notice 2025-42. They remanded the matter to the IRS and terminated the case at the trial court level. I've been told, or at least there's a rumor, that a notice of appeal is expected from the IRS, but I'm not aware of anything yet being filed. And I will note to our audience, if you have any additional insights on the likelihood of the IRS appealing or any other status update on the appellate process, please do email us at contact@novogradac.com or post something on X and note at Novogradac. So I'll find it and I'll retweet it. So if there's any more recent updates that our audience has, we'll share that with the broader audience on X. Now, Tony, this came June 6th when the deadline was July 4th. At the time of the ruling, everyone looked at this and said, from an appeals perspective, we don't know if this is going to stand. So it's going to be pretty challenging for anyone to actually rely on it with any degree of confidence, not knowing it was going to withstand an appeals process. That being said, does that mean it had no impact as a practical matter, or does it have some possible impacts? What's your take on the practical impact of this court ruling?
Sure. When this court ruling first came out, there was a lot of buzz and excitement around it. I remember seeing it myself, and your immediate reaction is, oh my goodness, does this mean developers will be able to use the 5% safe harbor leading up to the July 4th deadline? That was the immediate reaction. So the question, you didn't wonder that for too long. I think you read it, thought about it, and then realized, wait a minute, this seems like it might be too good to be true, probably is too good to be true. Let's be careful here. And then it probably didn't take the industry 24 hours to agree that this is not something you want to rely on for tax planning purposes in terms of if you're a developer and you think this might mean I could use the 5% safe harbor before July 4th. I think most people agreed pretty quickly that that would be very risky to do. Okay. Now, what if the U.S. District Court's vacating of that notice, what if that ultimately holds? What if it turns out that if you did start construction or you incurred 5% or more of your costs prior to July 4th, could that actually have some benefit? Could you be a project out there that maybe you did incur 5% of the cost, but it might have been a project where you didn't even think you could rely on that. So you're assuming you didn't start construction, right? But you'd incur the cost anyway. Maybe you had panel orders in on some other project for some other reason. And it turns out that the court's vacating of that notice sticks. I don't know. You might see that there's some projects that developers where they thought those projects hadn't really met started construction ultimately turn out that they did. So you never know. There could be some projects out there that don't even realize they've started construction or they're not confident they've started construction. And down the road, you might find out that lo and behold, they meet the criteria. But for now, the prudent thinking is if you started construction on or before July 4th, it should have been under the physical work of a significant nature standard. And you certainly don't want to be relying on the 5% safe harbor unless your project was 1.5 megawatts AC or lower for solar. Okay. But we'll see. Time will tell.
Yeah, very good comment. Thank you for those insights. And as you and I discussed when we were preparing for the podcast, I totally agree that anyone that was dealing with this July 4th deadline should have been focused on the physical work test, unless they were small enough in size that the 5% was still available. They should have been very focused on the physical work test. And to me, the more interesting question is all of those that were focused on the physical work test, if this provision does stand, how that might alter the future implementation and build out of those projects on the physical work test. If they look at it and say, well, now I can apply the 5% test. And does that change the dynamics of what a given developer is doing with a given project? And that's something that we're talking to some clients about, and it'll be interesting to see how that plays out over time. And I'm sure it's something we'll be talking about at our next renewable energy attachment conference, but I'm getting ahead of myself a bit here. Is there anything else you want to say on that, or we can jump into the mid-year check-in?
Yeah, no, I think we've covered it. I think the takeaway is you never know. There could be some projects out there that get a new lease on life from a start of construction standpoint. Should that district court's vacating the notice stick?
So now let's turn to our 4 major areas. As I mentioned, 3 GAAP topics, 3 tax topics, 3 financial topics, 2 of which relate to cash distributions, and we want to talk about the Alta win case. So starting with GAAP, I know our audience is going to love this first of the 3 GAAP topics, adjusting journal entries. Who wouldn't want to talk about adjusting journal entries?
Nobody
Tony,
wants to talk about it, right?
Tell me why asset or fund manager should be thinking about adjusted journal entries right now.
Yeah, it doesn't get any more exciting than AJEs or adjusting journal entries, right?
We always go up from here.
That's right. Yeah, right. Not the most exciting topic, but it is a good asset management, fund management, even developer relevant topic. And these topics that we're talking about today, you could hit these topics at any time during the year. We put them at the mid-year point because some of these topics you can lose sight of a little bit. And then mid-year, it's good to catch up and look at these issues and think, okay, have we been dealing with these all year to date or not? Or do we need to look at these from this point forward? It doesn't mean you only need to look at these at the mid-year. You can consider these topics throughout the year, but mid-year is a good point to take a look and just revisit, have we been thinking about these issues? Now, the adjusting journal entries, it's actually a great topic, right? It's a very beneficial topic because a lot of financial statements that get audited, it's not uncommon where they might have one or more proposed adjusting journal entries where the client needs to fix their books and records as part of the audit process, right? A lot of clients will come back to us and say, hey, look, are there some things that we can do on our side to help make sure that our financial reporting is even smoother, better, more accurate, whatever, and which might benefit the audit process going forward? And one thing I like to tell them is, if you had any proposed adjusting journal entries from your auditors last year, that's a great place to start. A lot of times those could turn out to be recurring entries. So if you're a client, you look at those and you think, all right, I know how to book those. I know how to book the activity. It's within my control. I can do it. Why don't I just do it proactively? And that way next year when my financial statements get audited, we won't have to book those again. Or even better, as you're doing your unaudited financial statements throughout the year, you'll have even more accurate reporting to share with investors and lenders, et cetera. So that's a good place to start. And then auditors issue what's called management letters to their clients. Those letters point out a variety of helpful topics to their clients, important accounting estimates, accounting policies, those sorts of things. It's good to look at those management letters too, just to think, have you given the comments in the management letters full consideration, and are there any action items that could be implemented as a result of those management letter comments? It's a good opportunity just to make sure your financial reporting, internal financial reporting, is working as efficiently as possible.
I also think of it as a leveling up the workload perspective towards the end of the year. Oftentimes there's all sorts of deadlines in terms of meeting various tests, getting transactions closed, getting property placed in service and the like. So there can be a lot of activity at the end of the year. Obviously, at the beginning of the year, for calendar year taxpayers, you're very busy in terms of getting the audits and the tax returns processed for the prior year. And the mid-year is a good time to be trying to get a head start on stuff you have to do at the end of the year and or you'll have to do next year. And that takes us to our second topic in terms of getting a head start on next year. And that's just having a call with your auditors. So discuss why getting an update call with your auditors right now, mid-year, is a good idea.
Yeah. And the adjusting journal entries and those management letter comments provides a nice sort of launching point to have these mid-year calls with your accounting firms. You can schedule a call, discuss the entries. I'm sure you discussed them as the audit was getting finalized, but it's good opportunity to kind of go back to those entries, the comment letters, et cetera, and talk about the entries, talk about the comment letters, but then also talk about other aspects of your business. Any staffing changes, any accounting software changes? Are you implementing a new accounting software? Did you change controllers or CFOs or key accounting personnel? Are you thinking about changing any accounting policies or any changes to accounting estimates? Things that might impact your audit in the next year. Are you adding any new deals? Are you placing into service any new deals? Are you going to buy out one of your investors? Are you making any changes to your operating agreement? These types of things. These are great things to talk about with your auditors. Look, it's going to be Q4 before you know it. You're going to be closing your books right around the corner. And one thing is good, if the auditor is aware of some of these things, they can share with you some good, helpful feedback that might make it easier for you to close your books and records. And this starts the planning process for your year-end audit. And getting your auditor up to speed with what's going on with your company can only lead to a more transparent audit process. And again, that feedback that you get from your auditor in terms of tips, suggestions, et cetera, on how you can implement these things going forward can just ultimately lead to more efficient closing of books and records, more accurate closing, and ultimately quicker, more seamless financial reporting and auditing.
And I would just toss in your non-exhaustive list, any basis certifications that might be needed, AUPs, other compliance work that you need your accountant to be providing, to be discussing those now and getting them in the queue.
Yeah, and I'll just capitalize on that comment, Mike. So great, you're having a call with your auditor. Your auditor asks, are you doing any new deals? You say, yes, we're just about to start construction on a new facility. Maybe you haven't started construction on a new facility in a year or two, and you're not used to, say, PWA compliance. Okay, so you don't have it on your radar. And your auditor hears you say that, and they say, okay, that's great. You want to get a jump start on your PWA analysis because that can help mitigate the risk of potential PWA penalties, et cetera. Okay. Or maybe you're doing a new deal and you think you're going to qualify for domestic content tax credit adders. Well, some front-end planning should take place there. Maybe you need a financial model, et cetera. But some of these things can get missed if you're working a bit in a vacuum and not having these kind of open, regular conversations.
And as you point out, we're at a unique time period where you have new energy facilities that our clients are working on that fall under a variety of separate tax rules, which we're not going to go into here.
FIOC.
Go to our website. We have lots of good charts. Our partner, Josh Morris, has done an excellent job of creating a lot of charts to try to help identify which of the various new sets of rules apply to your project, if ever, and if so, when. It's a very involved period of time, and I'll leave it at that. All renewable energy developments are not the same right now, even if they're all solar. So let's go to our third topic, our third GAAP topic, I should say. And that has to do with more of the kind of the GAAP reporting approach. And that's that an investor would end up using. There's the hypothetical liquidation book value, HLBV, and then there's also proportional amortization. Please describe for our audience very briefly these two methods and then what they should be thinking about right now with respect to these methods that their investors are likely using.
Great. So, if you're a tax equity investor in one of these renewable energy partnerships, if your deal is structured the way most are, then most likely the investor is accounting for their investment in the partnership as an equity method investment. And if you have an equity method investment in a renewable energy partnership, you need to account for that under one of two different sort of approaches. One is the HLBV approach, and the other is the proportional amortization approach. And this is a particularly relevant comment if you have some new deals, right? So if you're a developer, you've got a new deal, you got your investor, you placed a facility in service, you want to ask your investor, are you using proportional amortization or are you using HLBV? A lot of investors expect or prefer that the developer take a lead on HLBV and PAM in accounting and tee up some of the GAAP financial accounting under the method that the investor uses. Proportional amortization is a simpler method to use, and so it's kind of easier to implement. They might not need as much assistance there, but you want to ask. And then if you're unsure of how to apply PAM, reach out to us. We do a lot of that. So we could help you understand how to implement PAM for your investor. If they're using HLBV, then that can be a more complicated, in-depth analysis. Again, we do a lot of HLBV accounting for investors and developers. And so the nice thing about if your investor uses HLBV, one of the nice things about that is if you're doing HLBV for them, the results benefit them, meaning they can use them. And then so can you, because HLBV would also apply to the sponsor side of accounting as well. But there is some legwork in setting up HLBV for the first time when you place a facility in service. There's some time that goes into reading through the operating agreement, reading the cash waterfall provisions, allocation provisions, liquidation provisions, et cetera. And there's some financial modeling involved there. And there's a little bit of a lead time. So if you haven't done it yet, this is a great time of the year. Just get those mechanics built out. And if you're unsure of how to do that, again, feel free to reach out to us. We do a lot of this. We'd be happy to help you make sure you're applying the HLBV calculations in accordance with your accounting policies and guidance.
And I will include in the show notes additional resources on and what's also called PAM, proportional amortization method. So if those of you aren't as familiar with these two approaches, just go to the show notes and access some of the resources we have there. And of course, Tony's contact information will be in the show notes, as well as you can reach out to him directly.
So yeah, and I do a lot of consulting on PAM and HLBV, Mike. This is the last one there. I do kind of like a 101 for PAM and HLBV, both for developers and investors. So if you're new to this and you want a better understanding of the rules and how they work, feel free to reach out to me. I've got a really nice 1-hour tutorial I can walk you through to better understand those rules.
So thank you for that, Tony. Now let's turn to our tax topics. And let's start with the year-end tax returns. For those taxpayers that are calendar year and the project's being held by a partnership, what portion of them do you think have already filed their returns right now versus are in the process of finalizing them? And what are some of the reasons why, if they're not finalized yet, that there might be delays in having the 2025 returns finalized?
Great. Thanks for asking the question. Most partnership returns, tax partnerships that are like a tax equity style structure, most of those returns are not finalized within the initial filing deadline. It's pretty customary where the investor member wants the developer to file for an extension, and that extension for calendar year taxpayers would get them to a filing due date of September 15th. I point that out because whenever we work with new clients, new developers that are working with tax equity investors for the first time, many of them just assume that the investor absolutely does not want their return going on extension. And they'll call us up and they say, we need to get this return finalized on or before March 15th. And I'll point out to them, well, take a look at your partnership agreement because your partnership agreement does spell out when they want the returns finalized. And most investors prefer to get a draft return during the winter months, and then that the developer put that extension on extension, and then the return gets reviewed and approved by the investor sometime between April, call it the end of summer. Now, why is that? Well, the investor has a lot of investments. They want time to do a careful review to make sure they're comfortable with the results. That's one reason. Another reason is the state and local, there's a lot of state and local tax reporting that needs to go along, not just the federal side of things. There can be some tax payments due at the state level, and the investors want ample time to understand sort of the state and local tax ramifications with these partnership returns. And so as a result, the general preference, and some investors may want them finalized during the winter, but most tend to want more time to finalize the returns. So summer is a very busy time for doing that.
And how about if partnership's going to be transferring the tax credit? Explain to our audience the interaction between filing of the return and the transfer of the tax credit to a buyer.
Great question. So be careful if you're planning on transferring the tax credits. If you haven't signed that transfer agreement yet, or the cash payment for the tax credit transfer hasn't happened yet, you want to hold off on filing your return until you've finalized that transfer agreement. That cash payment transfer has to take place on or before the date either the buyer or seller finalizes their returns. Okay, so in a transfer situation, again, if the transfer execution is still in progress, you make sure you're having really good, close, careful communication with your transferee and the transfer to make sure the parties are on board with the tax returns and the status of the filings. You do not want to rush ahead and file your return if you don't have that transfer already in place and finalized.
No, as you know, in all the various areas where we practice, I can't tell our audience how many times we get a client because the person they were using wasn't very experienced and needed up having foot faults in a variety of areas. And this is one where if you have an inexperienced tax preparer, there could easily be a foot fault that is quite consequential.
Oh my goodness. Yeah, exactly. We did have some company call us and say, hey, we forgot to do the transfer before we file the return. We'd like to do this as part of an amended return. And that doesn't really work. So be very careful. Okay. With these transfers, make sure that the transfer is done and finalized before you finalize your tax return.
No, I'm sure a lot. I was just thinking, well, of course, Mike, you're going to say that because you guys are very experienced. You're going to tell people to use experienced professionals. It's obviously a statement that I have a lot of self-interest in, but it's also just the right approach.
Definitely.
So let's turn now to the tax returns has to do with penalties. I did mention earlier compliance, prevailing wage and apprenticeship compliance. And one of the reasons why you're focused on that compliance is to avoid penalties. What would you like to share with our audience about the penalties, and maybe give examples how having to pay prevailing wage and apprenticeship penalties is not rare for renewable energy projects?
Yeah, it's not rare at all. So if you're building a renewable energy facility, you're required to pay your construction or the workers that are doing work on the facility. Any of the journey workers have to be paid at least the prevailing wage. And then in addition to that, you have to use apprentices for a minimum percentage of the construction hours devoted to the facility. Okay. There's a lot of like nuanced rules there, and there's some easy traps you can fall into that can trigger a penalty. Some of those can be avoided if you're continuously monitoring construction and PWA compliance throughout construction. That's very helpful to help avoid or mitigate the risk of these types of penalties. But we do see plenty of tax returns, taxpayers where they were trying to comply, but little things can actually trigger a penalty. For example, the most classic example that triggers a penalty is you have an apprentice working on site. Apprentices have to be supervised by one or more journey workers. Well, if one apprentice goes out to the site and works 8 hours that day, they show up at 9 a.m., they start working. The journey worker also shows up at 9 a.m., and the journey worker is there to provide adequate supervision. But lo and behold, at some point during the day, the journey worker gets sick or had to go home or go to a different site or whatever. And so for a portion of the day, the apprentice was left unsupervised. Okay. Well, unfortunately, what that means is the hours that the apprentice was unsupervised, those no longer qualify as apprentice hours. And that apprentice, for those unsupervised hours, they're actually required to be paid prevailing wages as if they were a journey worker. That is probably the most common scenario that triggers an unrealized underpayment of what they think is an apprentice. And then if that gets unrecognized and that apprentice isn't made whole with respect to underpaid wages in a very timely manner, then that can trigger a penalty. So we do see penalties on a lot of different tax returns. And one thing I just want to point out with the PWA penalties at this time of the year, as you're trying to finalize your returns, the IRS has a new form for 2025 where you have to report the PWA penalty activity. And it's not easy to fill out. They want the information parsed out by job penalty per job classification. Okay. And most taxpayers, they don't have that information readily available to put on the form 7220. And so we're seeing a lot of tax returns right now that are trying to get finalized that are getting held up at the last hour as taxpayers scramble to pull together the information to report the penalties as the IRS requires. So if you're looking to finalize your returns in the near term and you think you've got PWA penalties, definitely talk to your tax return preparer to make sure you're getting the information organized to report those PWA penalties, because it can be a bit time consuming.
So the one other topic I wanted to cover on the tax side, which actually in some ways transitions to our topics on financial aspects of cash distributions. And the final tax topic has to do with non-resident withholding on partnership distributions. So please unpack that concept for our audience and what they should be thinking about with respect to those obligations a year.
Great. So partnerships don't pay federal income taxes, right? They're conduits, they're pass-through entities. So at the federal level, the partnership's tax attributes get passed through to its members, and the partnership return itself doesn't have a tax liability. At the state level, though, not all states follow that same sort of concept. There are many states that either tax the entity at the entity level, or some states will say, look, to the extent you've got non-resident partners at the state level, if there's positive income and you have non-resident partners, we're nervous that non-resident might not file a return in here. And as a result, we're nervous that we might not get paid our tax. And we're going to require that the partnership pay tax on behalf of the income attributable to that non-resident partner. Okay. Sometimes that can be a meaningful amount. A taxpayer, a client can get caught off guard late in the tax return finalizing process, where the client gets notified that there's this state and local tax payment due attributable to a non-resident. So if you're in the midst of finalizing your returns, if you haven't seen your state and local returns yet, and you know you've got at least positive taxable income on the federal side, that is a huge tip that there could be some state non-resident withholding required. So if you're an asset manager, a fund manager, or even a developer, If you haven't finalized your returns yet, email your CPA and say, look, as we approach finalizing the returns, I want to make sure what our payments do look like. So if you're seeing any potential state and local tax payments due, please let us know, especially with respect to non-resident partners. Now, here's a planning tip for you. Some states, many states actually allow non-resident partners to sign what's called a non-resident affidavit form.
Yes.
And that's a powerful tool because what that allows the partnership to do is to say, look, our non-resident partner has agreed to pay whatever tax they're subject to at their partner level. As a result, the partnership itself is exempt from that obligation. Now, not all states allow for a non-resident affidavit, so you want to make sure the state does allow for it. And the timing of when you get that non-resident affidavit form is important, okay? It's not as if you can just get that non-resident affidavit form whenever you want. Oftentimes that affidavit has to be in hand early in the year. So it's at this stage of the game for 2025, it's more of a planning tip if you haven't already dealt with it in the past, all right? The affidavits are extremely helpful because even most investors would prefer to deal with the tax almost always at their level as opposed to having it get paid at the lower tier partnership level.
I would just say it's equivalent to getting withholding on a W-2. It's just the partnership K1 has to show the withholding to the partners, and there can be other reporting requirements as well.
Something really annoying
back to the mid-year check-in point, because if you talk about the new transactions, this is a great sort of issue. You'd say, well, if I'm starting a new transaction, let's identify who the partners are. Let's identify, is there any non-resident withholding requirements? Let's identify, is there this waiver approach? So that you know now what's going to happen next year. It's not something that you're dealing with in the heart of busy season in terms of how to implement these withholding requirements. So let's move on to our final bucket of topics, the financial topics, and then we'll get to Alta when our bonus topic as part of our 10. And I wanted to start with cash distributions. And the first area of cash distributions I want you to talk about has to do with priority return payments. So many renewable energy developments, there are priority return payments to investors. If you could explain some of the typical priority return payments, obligations, and why it's something to be thinking about right now here.
Great. So think of a typical tax equity partnership flip transaction where you have a 99% tax equity investor. Very common that tax equity investor requires an annual, I'll call it a priority distribution. Sometimes it's called a preferred return or priority return. They all mean the same thing. But anyway, the investor requires a preferred distribution equal to some percentage of their invested capital. Classic would be 2 to 3% per year multiplied by their invested capital, paid out to them as a priority distribution of cash. Now, why is this a good mid-year sort of catch-up topic? It's because I've seen this over the years where the investor's earning priority return payments, but the payments are just, they're falling behind schedule in terms of when they get paid. And so we hear from a lot of investors or syndicators that say they're accruing built up priority returns and they'd like to see those get paid sooner rather than later. And I don't think the delay in payments is due to anybody not trying to pay them or not trying to invoice them or anything like that. It's not like that. It's just typically people get busy, they're doing lots of different things, and it's not at the top of the priority list. And so as a result, it just gets overlooked inadvertently, I think, is my take on it, which is why it's a good topic just to toss out there as a reminder. So if this hasn't been front burner for you in a while, it's good to take a look and see where are you with your priority returns. It's a good topic for developers. It's a good topic for investors.
Of course, as you're noting earlier, check the partnership agreement. There are probably deadlines in terms of when the payments are due by and the like. And I think we all want to be good partners.
Yeah, that's right.
So the second area I wanted to chat about with respect to cash distributions has to do with what are commonly referred to as tax equivalency payments. So Tony, what is a tax equivalency payment? And once again, why are we focused on this mid-year?
Great. So a tax equivalency payment, also sometimes referred to as a tax liability distribution. Okay. What that means is some partners, investors in renewable energy partnerships might have a clause in the operating agreement that says something to the effect of, if the partnership allocates me positive taxable income, And that positive taxable income gives rise to a tax liability payment. And if that tax liability payment exceeds the amount of cash flow that I've been distributed by the partnership that year, then to the extent my tax bill from the allocated income exceeds the other cash that I've received, then that difference needs to be paid to me as what I'll call a tax equivalency payment. So let me throw some numbers around that just so it's easier to understand. Say the partnership allocated the investor $1 million of taxable income, right? And if you're not a partnership expert, it's good to know that being allocated income is not the same thing as receiving distributions of cash flow, okay? So your K1 has $1 million of line one ordinary income on it. Now, let's say you're a corporate investor and you're subject to the 21% corporate tax rate. So that would mean that you have a $1 million, 21% tax rate. That gets you to a $210,000 tax bill, right? Now, let's say the partnership distributed you cash that year and from priority returns and net distributable cash flow. Say the total distributions you got that year were 200 grand. Well, the 200 grand that you got in distributions is less than your tax bill of $210,000. Okay. That would trigger a tax equivalency payment of $10,000. See that? Tax bill is 210. You've only received cash distributions of 200. The investor's sort of net negative with respect to their tax bill. And so that would require the partnership to make an additional distribution to the partner of $10,000 in the form of what we call a tax equivalency payment. Okay. Why is this a good time of the year to talk about this? It's because those tax equivalency payments don't usually get determined until probably March, April. The partnership does its draft tax return during the wintertime, figures out what its taxable income is. And so right around March, April, you can figure out what the taxable income is. Probably sometime in April that you know what the tax equivalency payment amount is. Probably should have been paid by now, but maybe it wasn't. Okay, so you want to look and see, do we owe our investor a tax equivalency payment? Or if you're the investor, it's like, all right, am I owed money? Did they pay it to me? Let me get my money. Okay, this is a classic time of the year where you could see a tax equivalency payment still hanging out there as owed to the investor.
And this also segues into the other topic I wanted to cover here, which has to do with financial modeling. Because so much of what we've discussed so far, you ideally are including these considerations in your financial model, such that it's a reminder, if you're checking the financial model, to make sure that you're doing everything as that we talked about. And if it's not in your financial model, to incorporate it in your financial model. And then for your future models, include this level of detail. And I would think every year the financial model should get a little bit more accurate, a little bit tighter, if you will, a little bit more expansive as you're learning more things about the actual operations that you can be including in the projections. What do you think about when you're thinking of financial modeling for given development that's somewhere in the development to place in service time frame and operations with respect to the financial model during the year period?
So there's something I like to refer to as a tracking model. You know what I mean? You did your forecast when you closed on the financing. At that time, all the numbers were projected numbers or forecasted numbers. No actuals were in there.
And let me just say, as you've heard me say before, and our listeners and other members of the audience, I say all the time, the only thing you know for sure about a financial forecast is it's not going to happen exactly that way. There's going to be variation, and hopefully the variation isn't very material.
That's right. That's right. That's right. All right. So once the facility gets placed in service and you start generating actual results, now you want to update that forecast with actual results. And so now 2025 is over. You've got K1s and you want to go back to that forecast or projection, and you want to replace the 2025 forecasted or projected numbers with what actually happened. Okay. And as you do that, you'll see if that means you're ahead of schedule on meeting your investors' return, behind schedule on meeting your investors' returns, and even if you're beginning ahead or behind on meeting your own sponsor returns, okay? And as you go throughout the life cycle of your investment, as you fine-tune that model, as you said, it gets improved over time and better and better. I'm going to talk about it now from the sponsor's perspective. As you get closer to your call option period, now your call option period, if it's an ITC deal, happens after the 5-year ITC compliance period. Most of these partnership flip arrangements have a call mechanism built in where the sponsor has the right to buy out the investor's interest, right? Well, that buyout price is oftentimes tied to whatever the fair market value of that investor's interest is at that time. People try to guess at what that is, and the way they estimate or analyze that is looking at the anticipated future cash flows that the investor is entitled to if they were to stay in the deal. And so as you keep fine-tuning that model and getting it better and better, you're going to get a better, clearer impression as far as what it might cost you to buy out your investor, okay, to hit their targeted returns. And so if you're not updating the model with actual results, you're kind of setting yourself up for either a really pleasant or unpleasant surprise. And really, you want to manage that unpleasant surprise risk, and you want to keep that model fresh and up to date with actual results.
I think you're labeling it the tracking model is exactly the right point to be mentioning, because when you're updating it for actual, you're also updating your projection of what hasn't happened yet based on what has happened. And you get to see how the transaction now looks like it'll play out over the term. And that's something where we both have the horror stories where there wasn't a tracking model in place. Initially, the transaction made financial sense, capital accounts worked. There was cash there to make the distribution required. You knew what the exit price ranges would be and things of that nature. You had it all set out at the beginning. And then you started doing work on, you started building it, placing the service and the rest. And some of these expectations have now morphed based on what has actually happened so far. And ideally, the tracking model is being updated, it's being anticipated. And sometimes you have to take steps now to avoid bad results later. Whereas if you're not doing the tracking model and you're just operating along the way, suddenly the situation presents itself and your ways and your opportunities to deal with it prospectively are no longer there. You can severely worse financial results as a consequence. And I realize that's all very high level, and I'm not going to give specific examples. We don't have time for that. But I'm sure there are lots of times where you've seen that. And once again, oftentimes comes in with new clients when these situations have occurred because they weren't using the tracking model and identifying it early enough. So I won't ask you to share any horror stories. I do want to turn to the Alta win case, but first of all, thanks for going through those various topics that we've covered so far about midyear. I also think midyear, just coincidentally, is when this long-running Alta win case that the United States Court of Federal Claims issued a post-remand trial order. And it has to do with a long-running dispute that, when I say long-running, we're going back to President Barack Obama's first term, and we're dealing with a issue around the cash grant program available at the time. And the central dispute in the case was how you determine the basis of eligible property for purposes of calculating the 30% cash grant that was available at the time. Now, the taxpayer, Alta Win, was arguing for an income-based discounted cash flow methodology. The government was advocating a cost-based approach. The court ultimately sided with the government in using a cost-based approach. However, the court adopted a substantially modified version of the government's cost approach, and a lot of those modifications were favorable towards the taxpayer. Now, I'll note that the income-based approach wasn't adopted by the court because, in the court's view, Alta Win developers, their methodology failed because it didn't factually support the inclusion of the anticipated value of the cash grant. Now, it's important from my perspective to know that the court, wasn't the tax court, the court did not hold that the discounted cash flow methodology was legally impermissible. Rather, it rejected the calculation that was submitted by Alta Win as not having sufficient factual support. So, Tony, that's my super high level perception of the key parts of the opinion that we've been waiting on for so long. Please share any additional insights you have with respect to my summary, as well as what the response for the renewable energy tax credit community is right now that the court ruling is out.
Yeah, I think you nailed it. You summarized it nicely. The industry's been following Alta Wind since, like you said, back to the Obama's first administration, watching it very closely. I think the industry was worried that this recent update was going to be more negative to the industry, more harmful. I think the fear was that the result would be that the court would say that, yeah, you can't use the income approach anymore. You can only use the cost-based approach, and you can't take into consideration a discounted cash flow method. There were some people in the industry up until recently that thought, well, maybe that's the way it's going to go at the end of the day. Maybe the IRS is going to ultimately say you can no longer use the discounted cash flow method. You can only use the cost-based approach. That wasn't the majority of the industry, but there were some voices in the industry that wondered that. Most people in the industry, though, have assumed that the discounted cash flow method is a permissible method and that you should be able to use it. And so I think this recent update to the Alta Wind case is helpful because I think it just helps confirm to most people in the industry that the income approach is a permissible method to use. Okay. I think that's a huge positive. The other thing that this most recent update to the Alta Wind case did was acknowledged that some developer fees are allowable. Okay. This case did acknowledge some developer fee margin includable on eligible basis. So I think was well received by the industry. To be honest with you, I think the takeaway is that the industry has been doing consistently what this recent update announced, essentially. I think the industry is relieved, thinking, okay, we don't need to really change what we've been doing for the last several years in terms of how we're analyzing eligible basis and the methodologies that we're using to evaluate the portion of total cost basis that's eligible for the ITC.
And you said eligible for the ITC, and that creates kind of the link because I could see a member of our audience saying, well, wait a second, Mike, you said that this has to do with the amount eligible for a cash grant. You can't get cash grants anymore, so why do I care? And I think what you implied in your talking about the ITC is that by analogy, this is the opinion of the court dealing with a cash grant, and then by analogy, some aspects of this are relevant for determining basis or purpose of determining the tax credit. And that you're looking at those two and saying what parts of it are analogous, what parts of it aren't, and how do the two interrelate, which is why it's not a direct apples to apples sort of comparison. It's more apples to pears. It's more like a pear than an orange.
That's right. That's right.
But there is this relationship, and that's what industry's now digesting.
That's right.
Is what are those distinctions and what impact does this have? And as I noted, it's all about the level of factual support provided with respect to the discounted cash flow analysis.
Yeah, I don't think you're going to see a significant change in the way the industry is approaching ITC eligible basis as a result.
So thank you for that. We have lots of resources on initial analysis of the Alta Wind case, and I'll link to that in our show notes as well. And you can also just Google Alta Wind Novogradac, and that'll take you to a variety of resources. With that, Tony, before we get to the outbreak section, let me say thank you for joining me on the podcast. That said, what additional resources would you like to direct our audience to review some of the items we covered in the course of the podcast or renewable energy related more broadly?
Yeah, first off, obviously reach out to me directly. Okay. The other thing you can do is I encourage folks to look into our renewable energy working group. Novogradac helps run the renewable energy working group. It's comprised of stakeholders in the industry, developers, lenders, investors, attorneys, etc. Great consensus building organization, helps advocate on behalf of important issues for the renewable energy industry. We meet monthly. We also meet in person at our renewable energy conferences, which that's another great resource. We've got our next renewable energy conference in Washington, D.C. on November 4th and 5th. I'm chairing the conference, which I've been doing now for probably more than 15 years running. And so I encourage folks to sign up for the conference. Great to see you.
And let me just interject. I'd encourage folks to register early for the conference. But I have no doubt that we're going to get sold out, in part because you said the dates are November 4th and 5th in Washington, D.C. So what else is happening that week, Tony?
I don't know. Nothing important, right? Midterm elections, maybe?
Maybe. For those who were there 2 years ago, we had the presidential election. And I remember leading up to that, Tony, that we were talking about the conference. And we're like, I wonder if we'll know who's president by then. I wonder if we're going to know who controls the House and the Senate. And I was actually pretty surprised that by the date of our conference that Thursday, we pretty much knew that it had been a Republican sweep. It wasn't entirely clear, but it was highly probable that both the Senate and the House were going to be under Republican control, and the House was the one that wasn't quite called yet, but it was all but called. And then obviously there was a buzz about what does this mean for renewable energy credits, and obviously it led to the pullback of so many of the renewable energy tax credit incentives. Here, there's a 50-50 chance the Senate will go Democratic, and there's an 80% chance, and these are Kalshi market. These aren't mine or yours, Tony. These are Kalshi market estimates, 80% chance that the House will go Democratic. So there's going to be quite a buzz at the conference talking about what the election results are, and as well as what does that mean for the renewable energy space. I feel like those that were at the conference in 2024 really got a head start on what this could mean. And I think we'll be very focused at the conference on what the election results will mean. Now, it could be that we don't know about the control of the Senate or the control of the House by then. I suspect we'll know the Senate. And if the wave that some are predicting, the blue wave, then we'll know the House as well, or at least we'll be in a similar place in 2024 where you have a strong sense as to which way that's going to go. And then we'll be prognosticating what we think could or couldn't happen with respect to renewable energy tax credit space. So anyways, as you can tell, I'm excited about the conference.
Oh my goodness. Yeah, I've been chairing this conference going back to the Obama administration. I'm telling you, this conference has always been in that week following an election. Okay. We've been in DC for this conference around so many incredibly important elections impacting this industry. I can't tell you how many times I've been sitting at that conference in your Washington wire panel. Okay. And thinking to myself, there's no place I'd rather be right now than right here the day after the election or 2 days after the election, listening to these experts talking about what the election results might mean to renewable energy tax policy. Timing couldn't be better.
Couldn't be better. And obviously leading up to the elections, you have to be pretty focused on the various outcomes that can happen and planning accordingly. And to me, it just helps us narrow the lens of what we talk about in terms of what is or isn't possible.
Mike, this podcast has been a little character revealing. Okay. Initially, I wanted to talk about adjusting journal entries. Okay. And then just now I revealed that following the election, there's no place I would rather be than sitting in DC listening to a renewable energy tax policy conversation.
And mega dittos. So thank you, Tony. To our audience, thank you for joining us. If you enjoyed today's episode, please subscribe to Tax Credit Tuesday on your favorite podcast platform. And I'll note that we do now include Amazon Music, Audible, and iHeartRadio. Please also share the episode with colleagues, and please do visit today's show notes for additional resources. Also, another housekeeping detail here for our audience. We recently added a variety of playlists to the Novogradac YouTube channel for episodes of Tax Credit Tuesday. And these playlists fall into several categories. One of the playlist sections focus on renewable energy credits, long-vested tax credits, new market tax credits, and the like. Another area focuses more on specific playlists like rent and income limits, advocacy, guidance and trends in various tax incentive areas. And then a third area deals with our recurring series. We have 3 recurring series on Tax Credit Tuesday. We have the So You Want to Be a Light Tech Developer series. We have the Watch and Watch series. And of course, we have the Renewable Energy Tax Credit Finance series. So there you could actually see many of Tony's 39 previous appearances. And I will include a link to those playlists in today's show notes. As I say every week, if you have additional ideas for future podcasts, please just send us an email at contact@novoco.com. You can also use that if you have updates on anything that we discussed here today, or if there's something we should have mentioned that you think is important mid-year that we didn't mention. And with that, let's turn to our off-mic section, where we use this space to give a shout out to others working in the tax credit and tax incentive communities. And I'd be remiss if I didn't point out, Tony was the one who introduced this feature to Tax Credit Tuesday. So thank you for that, Tony. And with that, Tony, who would you like to shout out?
Great. Thanks, Mike. So I'm going to shout out Chris Diaz from Seminole Financial Services. Seminole Financial Services is known primarily as a construction lender in the renewable energy space, construction to perm lender. They even syndicate renewable energy tax credits. Chris Diaz was one of my first professional colleagues in renewables. We started working in this area, I think, back in 2006, the first year that the solar tax credit went from 10% to 30%. He was one of the first people to reach out to me in the industry to get together to talk about ways we could maybe make a name for ourselves in the space. I've known Chris even before that when he worked at Midland, the syndicator of low-income housing tax credits. So I've known him for, I don't know, right since the turn of the century.
Turn of the millennium? So I echo your shout out. Thanks for all the great work that you do, Chris. Tony, thanks for being on the podcast today. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.